The 3 ETF portfolio is known for how simple and effective it is by offering you diversification, low cost, and solid performance. But by adding just one more ETF, you can fill in some of those gaps and get more diversification and growth out of your portfolio. And in this video, I'll be breaking down a few different types of ETFs, and I'll give you examples of some 4 ETF portfolios to help you build a portfolio that aligns with your goals. The first ETF is a broad market ETF. Broad market ETFs are funds that give you exposure to a wide range of companies, sectors, and sometimes even countries, making them an ideal foundation for most portfolios. These ETFs typically track large indexes like the S&P 500, the total US stock market, or even the global market, offering instant diversification. Because they include hundreds or even thousands of stocks spread across various industries, they help reduce the risk of being too exposed to any one area of the market. If one sector struggles, the strength of other holdings can help cushion the blow, which is especially important during bear markets or economic downturns. Over time, broad market ETFs have shown a strong track record of delivering reliable growth and consistent long-term returns through a wide range of market conditions. While they do carry some risk like any stock-based investments do, their diversified nature helps to smooth out things compared to the more concentrated or aggressive ETFs. Here's a list of some other broad market ETFs that you can take a look into later. Examples of broad market ETFs include Vanguard's S&P 500 ETF VOO that tracks the largest 500 companies, Vanguard's Total Stock Market Fund VTI, which includes the whole US stock market, and Vanguard's Total World Fund VT that holds US and international stocks. These funds don't aim to beat the market, but they are designed to match its performance closely, making them very dependable options for building wealth steadily over time. For investors looking for a balance between growth, diversification, and manageable risk, broad market ETFs continue to be a smart and time-tested choice. Second on the list is a dividend ETF. Dividend ETFs are designed to invest in companies that regularly pay out a portion of their profits to their shareholders, which are what dividends are. These funds provide consistent income whether the market is going up or down, and this makes them appealing for investors that are looking for another stream of income, whether that's for covering expenses or to live off of dividends during retirement. Since many dividend-paying companies are mature and financially stable, these ETFs are typically less volatile than broad market or growth funds. Along with the income they provide, dividend ETFs also offer the potential for long-term capital appreciation, and this lets investors benefit from both price growth and dividend payments over time. While all dividend ETFs do strive to provide income, their strategies can differ. Some focus on companies with a strong history of growing dividends year after year, while others aim for higher dividend yields, meaning they include companies that pay out larger dividends. During downturns, so market corrections or bear markets, dividend ETFs can be attractive due to their stability and reliable income. Here's a list of some dividend ETFs that you can come back to and take a look at later on. Dividend ETFs that I like include DGRO, the iShares Core Dividend Growth ETF, which is focused on companies with a history of dividend growth, and VYM, the Vanguard High Dividend Yield ETF, which offers great stability and a solid dividend yield. Dividend ETFs can be a solid piece to a portfolio, offering you steady returns, income, and less volatility. Next up, we have a growth ETF. Growth ETFs are for investors that are looking to maximize the potential returns of their portfolio by targeting companies that are rapidly expanding their revenues, market share, and overall business operations. These funds are typically made up of stocks that are in sectors like technology, healthcare, communication, and consumer discretionary, and in primarily emerging and innovative industries. Unlike dividend ETFs that prioritize income and stability, growth ETFs lean into momentum and future expected growth potential, often including some of the most well-known names like Apple, Microsoft, and Amazon. Over time, growth ETFs have shown the ability to largely outperform broader market S&P 500 funds like VOO, providing some impressive gains when the market is favorable. However, these higher returns do come with trade-offs. Growth ETFs tend to be more volatile and carry higher risk than broad market and dividend funds. Their performance can be heavily influenced by earning reports, economic uncertainty, and shifts in investor sentiment, especially during downturns. Because of their narrower diversification and higher beta, these ETFs are better suited for investors with a longer time horizon and higher tolerance for risk and market fluctuations. Here's a list of some growth ETFs that you can come back and take a look at later on. Examples of some growth ETFs include QQQM, the Invesco NASDAQ 100 ETF that invests in the largest 100 non-financial companies in the NASDAQ index, and SCHG, the Charles Schwab U.S. Large Cap Growth ETF, and this fund invests in growth stocks of large cap companies. While growth ETFs can play an exciting and rewarding role in a portfolio, when creating a well-rounded portfolio, it's best to pair these with more stable and diversified ETFs like broad market or dividend ETFs. Now, the remaining ETF categories on this list are going to be making up the fourth piece to our 4 ETF portfolios to bump up that diversification even more. First up, for the fourth ETF in this portfolio, we have international ETFs. International ETFs give investors exposure to companies that are located outside of the United States, allowing you to tap into global economic growth beyond the domestic markets. These funds can include developed countries like those in Europe and Japan, as well as emerging markets such as India, Brazil, and others. Since international markets don't always move in sync with the US markets, adding international ETFs to your portfolio can help increase diversification, lower volatility, and offer a layer of protection to your portfolio when domestic markets are struggling. You're also able to spread your investments more broadly and help balance risk, along with potentially benefiting from the global trends that might not be reflected in the US markets. This makes international ETFs a valuable addition to US holdings, especially for investors that want to build a more resilient and globally balanced portfolio. Here's a list of some different international funds that you can look into later on. Alright, so for the first 4 ETF portfolio, we're going to have 60% in a broad market fund like VOO, 20% in SCHG, a growth ETF, 10% in VYM, a dividend ETF, and then 10% in Vanguard's VXUS for international. Keep in mind these allocation percentages can be adjusted to your investing needs and what you're comfortable with, since these examples are just giving you a base to work from. So over the last 10 years, this portfolio provided annual returns of around 13.5%, which is pretty solid, and compared to the S&P 500, it came 0.1% lower in those returns, and that's because international has not performed all too well in the past few years. But in 2025, international has outperformed the S&P 500. This portfolio setup is not for maximizing returns. The addition of international is to lower risk and improve diversification by not only having exposure to the domestic markets, but international as well. Next on the list is going to be small cap ETFs. Small cap ETFs invest in companies with market caps that range from $250 million to $2 billion. Because these are smaller and younger businesses, they tend to have much more room to grow compared to large cap companies. This makes them attractive for investors that are seeking higher growth potential and the possibility of outsized returns. In many broad market ETFs or S&P 500 funds, small caps might make up a very small percentage, or they might be entirely excluded. So including a small cap ETF improves diversification by adding exposure to a different segment of the market. Keep in mind the potential for higher rewards comes with a higher level of risk. Small cap companies are much more vulnerable to market downturns, economic uncertainty, and financial instability, which can lead to large price swings and more volatility. So while these funds can surge during bull markets, they can also suffer more during bear markets. For investors with a longer time horizon and a higher risk tolerance, small cap ETFs can offer some nice upside and diversification. Here's a list of some small cap ETFs that you can look into later on. So we have 2 different 4 ETF portfolios for this one. First up, we have the same 3 ETFs from before: VOO for broad, SCHG for growth, VYM for dividend, and then for our small cap, we have the Avantis Small Cap Value ETF, AVUV, all with the same allocation percentages. And since AVUV has only been around since September 2019, that will be the starting point. So over the last almost 6 years, this portfolio had annual returns of around 16%, which is definitely great results and nearly 0.5% more yearly than the market. The second portfolio is slightly different. Instead of having our growth fund, we're going to swap in an international fund, so VXUS at 10%, and slightly bump up our dividend and broad market allocation. And this setup is giving us exposure to just about the entire stock market, from small to large caps and international. The returns of this portfolio since September 2019 is 14% annually, which is great for a setup that's very well diversified like this. And if you wanted more growth exposure, you could put in a dividend ETF like DGRO that's more growth oriented, or have a growth ETF in there instead. This next one is very different from the others on this list, and that's a Bitcoin ETF. A Bitcoin ETF seeks to track the price of Bitcoin. They offer a simpler way for investors to get exposure to Bitcoin without the need of managing digital wallets or dealing with cryptocurrency exchanges. These ETFs can be bought and sold easily just like any other ETF through brokerages, making them much more accessible to your everyday investor. Even a small allocation to a Bitcoin ETF can play a large role in portfolio performance, given Bitcoin's historically volatile but very rewarding nature. Recently, the sentiment around crypto has shifted even more dramatically, mostly due to improved regulations and the passing of the Genius Act, which has brought more legitimacy to crypto overall. This has increased confidence with investors and made Bitcoin exposure through ETFs much more appealing. As the dominant force in the crypto market, Bitcoin continues to lead the way, and Bitcoin ETFs offer easy access into the higher risk, higher reward crypto space that gives investors the opportunity to diversify beyond the traditional assets. For this 4 ETF portfolio, we're going to have our broad, dividend, and growth funds, and then add a Bitcoin ETF, FBTC, the Fidelity Wise Origin Bitcoin Fund ETF. And 10% here will be allocated for Bitcoin. Since FBTC has only been around since January 2024, the history is short, but taking a look at the returns for the past year and a half, this portfolio had nearly 50% in total returns, which is pretty incredible. And FBTC on its own has had over 160% returns since it was created last year. For someone looking for exposure to Bitcoin, a portfolio setup similar to this could be an option, and you could lower the allocation sum if that's too high for you. And for someone that's looking to maximize on their portfolio diversification that also wants Bitcoin exposure, I think a portfolio with US markets, international, and Bitcoin exposure could do the trick. Now, if you want to know the one ETF that I'd pick if I could only pick one, then check out this video here. Or if you want to know how $60,000 and the ETF VOO could change everything for you, then be sure to check out this video here. I appreciate you watching. Don't forget to hit that like button and subscribe, and I'll be seeing you on the next one.